Have you ever noticed that some people seem to have a natural gift for investing, while others keep losing money even when they try to do everything right? The truth is, investing isn't about luck, it's about following principles that anyone can apply. Today, I'm going to reveal the 5 foolproof tips that turn ordinary investors into long-term winners. And pay attention. The last tip is what separates those who merely dream of wealth from those who actually achieve financial freedom. Chapter 1. The Ordinary Investor and the Power of Simplicity. Most people believe that to invest well, you need a lot of money, an economics degree, or access to secret market information. But the truth is different. Any ordinary person can become a smart investor by understanding and applying simple principles. The world of finance may seem complicated, but when you cut through the noise, you find that the basics are what truly work. Investing isn't about predicting the future, picking the hot stock of the moment, or getting rich quick. On the contrary, it's about building discipline and consistency. The ordinary investor, who works, pays bills, and still sets aside a portion for the future, has a powerful advantage. They can build wealth gradually without needing to risk everything at once. Many make the mistake of thinking only the rich can invest. But that's a myth. The secret lies in starting small, knowing where to put your money, and giving time to work its magic. The world's greatest investors started modestly but had one key difference: patience and a clear focus on the long term. Another crucial point is not falling for promises of easy gains. The ordinary investor needs to know there's no magic formula. If someone offers outrageous profits in a short time, rest assured, there's a huge risk hiding behind it. The real path to wealth is about respecting the fundamentals and acting intelligently. So, this first chapter is an invitation. See yourself as an investor, even if you have little money saved. It's not about the size of your initial capital, but the mindset you develop from now on. Simplicity, combined with discipline, is what transforms the ordinary into the extraordinary. Chapter 2. The first tip: invest only in what you understand. One of the biggest mistakes ordinary investors make is believing they need to jump into everything that's trending. Cryptocurrencies, startups, complex funds. It seems like a new irresistible opportunity pops up every day. But here's the truth: investing without understanding is like driving blindfolded. You might get lucky for a while, but the risk of a crash is huge. Big names in finance, like Warren Buffett, repeat a simple lesson: only invest in what you understand. This doesn't mean you need to be a technical expert, but you should know the basics of where your money is going. If you invest in a company, understand how it makes money. If you choose a fund, know how it works. If you opt for fixed income, understand the yield rules and the timeline. A practical example: imagine someone who puts all their savings into a cryptocurrency because a friend said it's going to explode. They didn't research the project, don't understand the risks, and don't even know how to withdraw their investment. The result, more often than not, is a loss. On the other hand, an investor who starts slowly, studying fixed income or a simple fund, builds a foundation of safety before venturing into something more complex. This tip is valuable because it protects you from financial traps. When you know what you're doing, you gain confidence, avoid impulsive decisions, and reduce the chance of falling for deceptive promises. Even basic knowledge acts as a shield against unnecessary losses. So, before investing your money, ask yourself a simple question: do I really understand how this works? If the answer is no, wait, study, and research. Only then take the next step. This mindset may seem obvious, but it's exactly what separates the smart investor from the gambler. Chapter 3. The second tip: diversify your investments. There's a well-known saying in the world of finance: don't put all your eggs in one basket. This simple phrase sums up the essence of diversification. If you put all your money into one asset, one stock, or one sector, you risk losing nearly everything if something goes wrong. Diversification is the strategy that protects the ordinary investor from major scares. Imagine you've put all your savings into the stocks of a single company. If it does well, great. But if it faces a crisis, a scandal, or loses market share, your wealth collapses with it. Now, if that same amount was spread across fixed income, stocks from different sectors, and even real estate funds, A drop in one area could be offset by gains in another. Diversifying doesn't mean scattering money randomly. On the contrary, it's about creating balance between safety and growth. A good example is combining low-risk investments, like government bonds, with options that offer higher return potential, like solid stocks or index funds. This way, you protect your foundation while leaving room for capital growth. Another key point is to think of diversification as a team. Each investment plays a role in your portfolio. Some provide stability, others offer long-term returns, and others protect against inflation. When they work together, the results are much more consistent. So, if you're an ordinary investor who wants to sleep soundly, diversification is essential. It's the difference between being hostage to a single outcome and having better odds of thriving, even when the market fluctuates. Diversifying is investing with intelligence and a vision for the future. Chapter 4. The third tip: think long-term. Ordinary investors often get caught up in the rush for quick results. They want immediate profits and believe they can multiply their wealth in a few months. But the financial market doesn't work that way. True growth happens over time. Thinking long-term is the key to building solid, lasting wealth. When you invest with a short-term mindset, anxiety takes over. If the market drops, you sell out of fear. If it rises, you buy in a frenzy. This constant back and forth is one of the biggest reasons so many people lose money. But those who stay focused on the future see market fluctuations as a natural part of the journey. A simple example: someone who invests $500 a month in an index fund for 15 or 20 years can accumulate hundreds of thousands of dollars thanks to compound interest. There was no magic, no rush, just discipline and patience. Time is the investor's greatest ally. Another important point is that great fortunes are rarely built overnight. Even the world's top investors, like Warren Buffett, achieve their results after decades of applying the same philosophy: buy good assets and hold them for the long haul. So, if you want to succeed in investing, adopt the mindset of a marathon runner, not a sprinter. Don't worry about immediate gains, but focus on consistency and discipline in your contributions. It's in the long term that your money truly works for you. Chapter 5. The fourth tip: control your emotions. The financial market can be thrilling but also treacherous. When prices soar, it's easy to get swept up in euphoria and believe the gains will never stop. When they plummet, fear takes over and many sell in a panic. This cycle of fear and greed is what destroys most ordinary investors' portfolios. Controlling your emotions is just as important as choosing good investments. After all, the best strategy is useless if you abandon it during turbulent times and act on impulse. Emotional discipline is what separates the patient investor from the speculator who keeps losing money. A practical example: imagine someone who buys shares in a solid company. Shortly after, the market drops 10%. In a panic, they sell, thinking they'll lose everything. Months later, the same company recovers and rises again. The result: they lost money not because they chose poorly but because they didn't have the patience to wait. On the other hand, the investor who stays calm and understands that dips are part of the journey reaps the rewards of patience. Instead of reacting to short-term fluctuations, they stick to their plan, keep contributing, and, over time, see results. The lesson is clear: the investor's greatest enemy isn't the market, it's their own emotions. Learn to master fear and greed, and you'll gain a power few can achieve. Chapter 6. The fifth tip: build the habit of investing regularly. Investing isn't a one-time event, it's a continuous process. Many people believe they need to wait until they have a lot of money to start, but that's a big misconception. What truly makes a difference is creating the habit of investing every month, even if it's a small amount. Consistency is the fuel that drives long-term growth. Think of someone who saves $200 a month. It may seem small, but over the years, combined with compound interest, that amount can grow into a significant sum. The secret is in the consistency. Investing regularly, even in small amounts, is more important than investing large sums sporadically. This habit also helps you better handle market fluctuations. When you invest regularly, you buy assets at different times. Sometimes when prices are high, sometimes when they're low. In the end, This reduces the risk of mistiming the market and brings balance to your portfolio. Moreover, investing becomes natural, almost automatic, like paying a fixed bill. When you include contributions in your monthly budget, they stop being an effort and become part of your financial life. This eliminates excuses and strengthens your discipline. So, don't wait for the perfect moment or a large sum to start. The best time is today with what you already have. The habit is more powerful than any promise of quick riches because it ensures consistency and real growth. Chapter 7: The Power of Compound Interest. There's a silent force that can turn small amounts into large fortunes over time. Compound interest. Many call it the eighth wonder of the world, because its effect is almost magical in the long term. For the ordinary investor, understanding and harnessing compound interest is a game changer. The logic is simple. You invest, that money earns returns, and in the next period, you earn returns not only on the initial amount but also on the accumulated returns. It's the famous money working for you. The longer you leave your money invested, the greater the impact of this multiplier effect. A practical example: if you invest $300 a month at an average annual rate of 10%, after 20 years, you'll have invested $72,000. But thanks to compound interest, the accumulated value could exceed $200,000. In other words, more than 2/3 of that amount comes solely from the power of time and returns. That's why starting early makes such a difference. The sooner you begin, the more time compound interest has to work in your favor. But if you haven't started yet, don't worry, the key is to take the first step now. Every month counts. The big lesson is, don't underestimate small amounts. Investing regularly, combined with the power of compound interest, can lead to results that seem unattainable today. Time is the ordinary investor's greatest ally. Chapter 8: Common Mistakes Investors Should Avoid. Knowing what to do is just as important as knowing what not to do. Many ordinary investors make mistakes that seem minor at first but can compromise their financial journey over time. Understanding these pitfalls is essential to avoid them and protect your results. One of the most common mistakes is investing without a plan. Many people put money into something just because they heard it's good or because it's trending. This lack of strategy leads to impulsive decisions and often losses. Investing should be a thoughtful action, not an impulse. Another frequent mistake is spending everything you earn and always postponing investing. This procrastination causes years to pass, and you lose the most valuable asset: time. Those who constantly delay miss out on the power of compound interest and fall behind. It's also common for beginner investors to believe they can predict the market. Buying and selling in an attempt to time the market perfectly almost always leads to more losses than gains. The truth is, no one can predict the future, and those who try usually end up disappointed. So, knowing these mistakes is the first step to avoiding them. If you steer clear of these traps, you'll already be ahead of most. Remember, investing is more about discipline and strategy than chasing fleeting trends. Chapter 9: The Importance of Financial Education. Money is a powerful tool, but few people have learned how to use it correctly. Most grow up hearing phrases like, "Money doesn't grow on trees," or "You have to work hard to earn." But rarely does anyone teach how to manage, invest, and grow money. This is where financial education comes in. Financial education means learning to make conscious decisions about your money. It's understanding the difference between spending and investing, recognizing risks and opportunities, and most importantly, building habits that strengthen your financial life. This is a skill that doesn't develop overnight but grows with consistent practice. A practical example: someone who understands compound interest and personal budgeting will never look at a credit card the same way. They know that debt can snowball and that interest-free installments are often a trap to spend beyond what's necessary. Financial education also liberates. When you master basic concepts, you stop being hostage to others' opinions, false promises, or fads. You start choosing consciously, based on your goals, not what others say is right. So, the ordinary investor should see financial education as an investment in themselves. The more knowledge you gain, the more confidence you'll have to build wealth and avoid costly mistakes in the future. Chapter 10: Setting Financial Goals and Objectives. Investing without goals is like sailing without a destination. You might row hard, but you'll never know if you're heading to the right place. The ordinary investor needs clarity about why they're investing: retirement, buying a house, financial independence, or simply future security. Having defined goals gives purpose and direction to the journey. When you set financial goals, everything changes. Saving stops being a sacrifice and becomes a concrete step towards something bigger. Saving $500 a month isn't just giving up a purchase. It's getting closer to the dream of a debt-free life or securing your children's education. A practical example: imagine two people investing the same amount every month. The first has no goal, just invests because it seems like a good idea. The second has a clear objective: save $200,000 in 15 years to buy a house. Who do you think will have more discipline and motivation to keep going? Without a doubt, the second. Goals also help you choose better investments. If your goal is short-term, like a trip, fixed income might be more suitable. If it's long-term, like retirement, assets with higher potential, like stocks or funds, may make more sense. So, before investing, stop and reflect. What's your big goal? The clearer your goals, the easier it is to stay disciplined, resist the temptation of instant gratification, and keep moving forward. Chapter 11: The Path to Financial Freedom. Ultimately, investing isn't just about numbers, charts, or bank accounts. It's about freedom. Freedom to choose where to work, how to live, and, above all, to not depend on circumstances or others to sustain your life. The ordinary investor who invests with discipline is, in reality, buying time and autonomy. Financial freedom doesn't happen overnight but is the result of many smart choices: spending less than you earn, investing regularly, diversifying, thinking long-term, and keeping emotions in check. Every decision you make today brings you closer to that future. A real example: people who started investing early, even with little, often achieve a comfortable life years later. Not because they got lucky, but because they respected the process. Financial freedom isn't a privilege for the few, it's a consequence of discipline and vision. The most inspiring part is that anyone can walk this path. It doesn't matter if you earn a lot or a little now. What matters is the mindset, believing it's possible, taking the first steps, and staying consistent. Wealth starts in the mind before it reaches your bank account. So, carry these tips with you on this journey. Use them as a guide to make better decisions and build a solid future. Financial freedom is within reach for those who decide to act. And that decision can be made today, by you. Now that you've made it this far, remember, knowledge only has value when put into practice. The 5 foolproof tips you've learned aren't distant theories but real tools that can transform your financial life. The next step is in your hands. Start small but start today. Invest in what you understand, diversify, think long-term, control your emotions, and, above all, build the habit of investing regularly. If this audiobook resonated with you, share it with someone who also needs to awaken to financial education. Together, we can spread this knowledge and help more people achieve freedom. Remember, every choice you make today brings you closer to or further from the life you want. Choose wisely. And never forget, the ordinary investor with discipline and vision can achieve extraordinary results. Financial freedom isn't a distant dream. It's a decision. Your decision.